Welcome to Beat the Streets on this Wednesday, the 25th of October. We're here to give you all the news and some of the movers expected on Wall Street in an hour's time, where we're expecting the markets to move as a result of earnings coming through that we've seen in their great number over the last 6 or 7 hours or so that could give a steer to the open of the Wall Street markets. Let's catch up with the headlines as we continue to monitor the wires going into the start of today's trade. We've just been hearing from Boeing shares on the way up on the IG platform, despite the third quarter loss worse than forecast. Microsoft shares climbing late last night after the bell on the news that AI land grab continues. So Microsoft, it continues to take market share through its Azure business. And Alphabet stock on the way down. A big disappointment for cloud revenues at the company. Well, let's take a look into more detail about what's happening as we go into the start of today's trade. I want to bring up a share price chart, first of all, or an index chart for the S&P 500. Just to show you what's happening, we've got a tiny little doji candle here, just trading below the 200-day moving average. It is looking as though we're only a point or two away from the close on the cash session yesterday, so it's looking as though we're not going to see much movement for the S&P 500. But let me tell you what's happening on the Dow, because it's a little bit of a different story that we got there at the moment. The Dow Jones Industrial Average yesterday closed at 33,141. 33,245 is where we're trading at the moment. We've got a positive move on the markets at the trading day at the moment. Unlike the S&P 500, we haven't gone below this line of support that we had drawn in the sand from the lows that we had back on the 4th of October at 32,813. Didn't quite get there. That doesn't mean to say that in the longer term picture, we're not going to try and get below that line again, because I think technically these lower lows, these lower highs that we've got are signaling in the longer term that there is a potential to break this line of support and go down to the next line of support at 32,584. Different sort of situation for some of the other movers. We've got a technical break of this line of support at 14,440 on the Nasdaq 100. And I think that piercing of that line does give us a little bit of an opportunity to take this market lower at some point in the future. MACD pointing down, indicating momentum is on the downside. I think people are just looking for a better price on which to go short on these markets. It's a question as to how far up the markets go before the next drop comes. Let me take a look in some more detail about what's been happening for some of the stocks I think that we are on the move to. And for that, I want to look at what's going on first of all with Boeing, because this number came in with a wider than expected adjusted loss for its third quarter. Adjusted loss per share, $3.26. We've been looking for $2.96. Revenues, $18.1 billion. We've been looking for $18 billion, the round number. The positive to be taken away was that the net loss of nearly 1.64 billion is an improvement from the same quarter this time last year when it lost 3.3 billion. It said today it'll deliver fewer 737 MAX aircraft than it expected this year as it works through the production flaws detected on some of its best-selling aircraft. Let me just quickly update you on what's been happening on the share price chart, because I said we've got a rise all sessions on the IG platform. This stock is currently trading up by a margin of 3.4%. On the trading day today, indicating a stronger open when trade gets underway in around about 56 minutes time. So this is going to be one of the stocks I think that will see a contribution on the upside. Another stock on the upside is going to be Microsoft. Shares up as much as 5% late in the trading day yesterday on extended trade after the software maker issued a fiscal first quarter result, which pleased the markets. Earnings per share, $2.99. Against $2.65 expected. Revenue, $56.5 billion. We've been looking for $54.5 billion. So that, again, better than expected. Revenue growing 13% year over year on the quarter, according to the statement. Microsoft's intelligent cloud segment produced $24.25 billion in revenues. Now, that was up 19%. This includes the Azure public cloud business, amongst other parts of the organization. The revenue there jumping 29% during the quarter, faster than the 26% consensus amongst analysts. And as a result of that, you can clearly see Microsoft up late in yesterday's session, past the closing bell last night. So we were already expecting Microsoft to contribute something like around about 5 or 6% in terms of added weight for its part of the market when things get underway in 50 odd minutes. Look at this as well today. We got a further climb of almost 1% on Microsoft stock in today's trade in the early session. So we're looking for a positive result on the markets when things get underway. Unlike Alphabet, which reported an 11% revenue growth in the third quarter, as a rebound in advertising pushed expansion to double digits for the first time in over a year. The problem was the cloud business. Let's take a look at these numbers. $1.55. Estimates have been for $1.45. That was good. Better than expected revenue, and the company continues to invest heavily in artificial intelligence. But the cloud revenue came in below estimates at 8.4 billion, missing the mark by more than something like around about 20 million. It's not much in terms of the miss, but it did nonetheless dent shares in extended trade last night, and you can see quite clearly here this big loss we saw, taking us very close to this line of support at $129.50 a share. We are currently trading 131.77. Pretty much the bottom of the candle of yesterday's trade, down over 5%. So you can see this company contributing something negative when we see things get underway later on. One other company I wanted to talk about was Snap. Now, this stock was up almost 25% after the markets closed last night on third quarter earnings, beating expectations on both earnings and revenue. You can see here we saw a profit when we were expecting a loss. We saw greater than expected revenue, daily active users better than expected, average revenue per user, $2.93. We had been looking for $2.47. Now, as part of Snap's internal forecast, the company said it expects sales in its fourth quarter to be in the range of between 132 to 138. That too was better than the mean 1.33 billion expected by analysts. The problem is the shares turned around later on into the evening by a considerable margin. Look at the share price movement we saw here. This is the upside wick that we saw, taking us all the way up at one point yesterday, up, as I said, by almost 25% to $12.02. And then came a really big retracement, almost down to where it opened yesterday's account. But in fact, it ended up around about 2.25% on the trading day. It has added a little bit of extra weight this morning. The problem is that late in the evening yesterday, investors digested the news that came through that some advertisers had paused spending following the onset of the war in the Middle East. So that gives us an idea as to how things are. I think net, all things are pretty much balanced, as we saw the S&P 500 not likely to move much at the start of today's trade. Before we catch up with our guests, very quickly, I wanted to take a look at what's happening a little bit later on this afternoon. Bank of Canada interest rates, it's widely expected to leave rates on hold at 5%. In July, the BOC hiked rates to a 22-year high of 5% and said more hikes may be needed, but it held in September as growth appeared to be weakening. Now, that trend has been confirmed with the growth effectively stalling in the month of July and August. One of the effects of the movement today could well be a move in the Canadian dollar. We have one element of the markets which we're seeing some recent upside in oil, which has given a little bit of a boost to inflation. And that could be something that we might see from the Bank of Canada when it comes through. Let's catch up with our guests now. Christopher Vecchio joins us now from tastylive, part of the IG group. Chris, welcome. Thanks indeed for coming in. Just briefly, in terms of where we are in the market, we heard one comment there from Snap talking about the effect of the war in Gaza. Now, we're here to talk about the market effect of all this. One obviously has to consider the dreadful tragedy that has befallen so many people on this. But the effects of this obviously being felt in corporate America. What are your thoughts in terms of the overall picture for trading on Wall Street and what we're seeing in terms of earnings that are coming through?
Well, with respect to the impact of the Israeli incursion into Gaza as a response to the tragedy that occurred on October 7th, we have to remember, where do companies get their earnings from, broadly speaking? And the fact of the matter is that revenues from Israel are very minuscule in the overall earnings pie. It seems to me that's a convenient excuse if companies are beginning to shift the blame to a burgeoning regional conflict that really has nothing to do with what happened in the third quarter. But it is something that is deteriorating sentiment very considerably here. We've seen that oil prices have been on the move, gold prices have been on the move. And as a result, unfortunately, it's been pushing perhaps treasury yields higher and concerns that there could be further supply chain issues down the line, all in all, which disrupted what has been a fairly strong market in October. The past 2 weeks, stocks have come back in meaningfully. Gold has challenged $2,000 an ounce, as it were. But I think the focus this week, quite frankly, as we look to a rather staid open this morning, is what happens with that US GDP report tomorrow. That is something that could help pave the path to a greater understanding for what the Fed may do at their meeting on November 1st, and then again when they meet in December to close out this year.
Let's take a look at the dollar basket ahead of that GDP number out tomorrow, because we haven't touched on the foreign exchange markets. And we've seen the dollar attract a little bit of weight in the last couple of days or so. This has taken the euro down to this rising line of support. How much of an effect could potentially the GDP number tomorrow have on the dollar? I mean, I'm mindful of the fact that in the longer term, we're looking towards what happens with the Fed on interest rates and what the outlook is for interest rates at the back end of the year. There's a lot of water to pass under the bridge before we get to that point. But tomorrow's GDP, how much of a critical move could it give to the US markets and the dollar in particular?
So when we think about decomposing the yield curve into the various influences, Fed policy is typically something that impacts the short end of the curve. Growth expectations are typically at the long end of the curve, which is why over the past several weeks, at least here in October, as we've seen US Treasury yields at the long end of the curve rise, the dollar really hasn't gone along for the ride. Two-year yields have been more or less bouncing around rather steady. And so from that perspective, anything that continues to push up growth expectations or inflation expectations may not necessarily feed into a strong US dollar. The question is whether or not a strong GDP report could actually move the Fed closer to raising rates once more. It's important to consider where the Fed has their anchor point for the rest of this year. In their September summary of economic projections, they were only looking at a 2.1% real GDP rate through the end of 2023. Now, if we put that in comparison to where the estimates are, we're looking at 4.3% for the Bloomberg consensus forecast. And more importantly, the Atlanta Fed GDP Now growth tracker, which was nails on for the first and second quarter GDP reports this year, is looking at 5.4%. So there's a non-zero risk that tomorrow's GDP report could come to a point where the market says, you know, this is so strong, the Fed's going to look at this, say that aggregate demand is running hotter than we anticipate. We need to do more in order to bring down the economy, bring the temperature down in the room. And so a further rate hike in December or even by January, quite frankly, can't necessarily be ruled out. If that happens, two-year yields are going up, and that event, that should be supportive for the US dollar. But it's the two-year yields that you want to keep an eye on, not the 10s or the 30s, which have been guarding so much of the attention here in recent weeks.
What about the price of oil? I mean, we've got the Bank of Canada today. The Canadian economy is in part it's a commodity economy. The price of oil has been up recently. Okay, it's a little bit softer now. Perhaps if you just take a quick look at where we are in terms of WTI, for example, $83.81. It's seen 3 days of losses, but nonetheless, it is elevated from the point we're at midsummer. And this is going to be a big contributory factor, I guess, to some of the commentary around not necessarily the Fed, but also the Bank of Canada on the potential for inflation driven by higher oil prices.
It's true. Higher oil prices right now are not doing anyone any favor. But the fact of the matter is that the year-over-year contribution to the CPI bucket is still a negative at this point in time. The Fed, of course, looks through energy prices, in part because they can't really do anything to influence them. I don't think Jerome Powell's going to get on the phone and call up the various energy ministers in OPEC and say, listen, we really need you to increase production moving forward. But there's this kind of, yin and yang dynamic right now where OPEC plus production cuts led by Saudi Arabia, of course, are running into the reality that global growth is slowing down, that China is slowing down. The Eurozone looks like it's teetering on the verge of a recession. The United States, for all of its warts and maladies over the past several months, it's been better than expected, but moving forward, there are reasons to think that growth could slow at the end of the year and going into 2024. So you have this, really aggressive juxtaposition where on one hand you have the geopolitical bid helping oil prices go up. You have the supply cuts helping prices go up. On the other, there is the stark reality that demand just isn't there the way it is. So more volatility is certainly expected, but the Fed looks through oil for a very good reason. And quite frankly, there is no interest rate that the Fed could levy to the market that would ultimately influence whether or not supply goes up or down in the very near term.
And of course, you've got to be mindful of the fact, and we were discussing this before we went to air, about the fact that wind the clock back 12, 14 months, we were looking potentially at a US economy in recession this year, and we're so far away from that. What has been the driving factor? Why have we steered a course away from recession? We can talk exactly the same thing here in the UK. We were looking at a recession here. We're closer than the US, there's no doubt about it, but we haven't hit it. Eurozone hasn't hit it. Close. But what is it that's held up the economies? What is it that's generated the heat that we've got? And especially in the US, expecting that 4.3% print tomorrow, which is a really good number compared to some of the growth numbers we're getting out from other economies.
For me, it's two things, if we think about the United States at least. First off, deficits. The government deficit through the fiscal year 2023 that ended up September was 1.7%. We're running the largest current account deficit relative to GDP, basically going back to World War II. We're doing wartime spending at a time when we don't have war, in effect. And if you decompose your GDP equation, C plus I plus G plus net exports, G has a positive coefficient. So if the government's spending money, it's going to help prop up the economy, plain and simple, even though there may be some other, nasty side effects like increased inflation. The other part of this, coming out of COVID, you have a very strong labor market, at least for workers. At their peak, there were 2 jobs available for every 1 worker in the United States. Job openings, JOLTS, were over 10 million, which we had never seen in U.S. history before. Basically, you could fall out of bed here in the United States and get a job if you wanted it. And so the labor market has not weakened to the degree that many people would expect in a typical type of cycle, because it's starting from such a, dilapidated point. It's been fundamentally broken. Even now, if you look across most states in the United States, there are fewer workers available to fill jobs than there are jobs currently listed. And that means there's work. People are not finding themselves without work. And so when workers have more power, when they have more wages, they can spend more. The United States is a consumption-based economy. 70% of our growth, very much like the UK, comes from consumption. Those 2 factors together, government spending and what has been a very, very strong labor market, has kept US GDP afloat here over the past year.
Interesting point. Let's just quickly wind it back full circle to what we were talking about in the beginning, and that is looking at these earnings and comparing them against what analysts are talking about. To what degree do you think analysts have been prepped, if you like, to look at the potential downside, because they had this belief that the US was going to go into recession? Do you think that analysts are estimating earnings because they think that the downside is more likely than the upside? Do you see what I mean? The analysts seem to be underpitching,
yes.
and companies are beating earnings quite consistently.
Companies have been beating earnings. Through the end of last week, 73% of companies reported a positive EPS surprise, and 66% reported a positive revenue surprise. However, if we look at the year-over-year earnings growth, it's been negative 0.4%. This would be the 4th quarter in a row that we've seen negative earnings growth here in the United States. I will say that it feels like people were plugging in their GDP expectations, which of course were wrong, into their earnings model, right? They're starting from this top-down sense where, if the economy is falling into recession, that means people are spending more. That means corporate earnings are going to be weaker than we anticipated. So it's created this nice little window where there's a very low bar to clear. They just need to jump over the credit card in order to beat their earnings. On the other hand, earnings haven't been all that impressive. The growth rate is still negative. In fact, if you think about earnings growth over the past year and the rise in stocks, you can then basically come to the conclusion that it's just been a multiples expansion. Anticipation that lower interest rates would eventually arise, that things would get better soon. That, of course, has not necessarily happened. The Fed has proceeded to raise rates very rapidly, and they show no intention of backing down at any point in the near future. And that may be problematic moving forward for stocks. Something has to give here. Either the economy needs to buckle, or companies need to start putting up better numbers on the board. I haven't been impressed thus far in this earnings season.
Okay, interesting. Christopher, thanks indeed for joining us. Christopher Vecchio from tastylive, taking us through some of the macro economic indicators and some of the thoughts about just how where we are in terms of the economic background and to some of these earnings. Christopher Vecchio. Let's take a look at a couple of other stocks worth looking at after the closing bell this evening. We will be looking for earnings out from Meta Platforms. This is a stock which is expected to see earnings per share of $3.64, revenues at $33.6 billion. The market will be looking for updates on its advertising revenues. It's that monetization that is so important for Meta across its many different platforms, be it Instagram or WhatsApp or whatever it might be. Facebook share price recently has escaped this little symmetrical triangle here. You can see that we are away from that red line, which I think is the $1 trillion mark for Facebook. If I can just expand this out, Facebook as it was, indeed, that is where that line is. But it has been a lot higher than that. In fact, the record highs we had going into the midsummer 2021, when we saw that record high at $348. The stock is trading at 310. You can trade this after the close of tonight's bell on the IG platform as an extended trade. So that is Meta Platforms, and IBM is the next one I want to quickly follow up on. It reports third-quarter results after the bell this evening. Analysts suggesting the company is likely to have recorded higher revenues from the software segment driven by innovative products and services. This includes AI, so much a driver these days for companies. During the third quarter, IBM unveiled Watson X, a cutting-edge enterprise-focused AI and data platform designed to harness the power of advanced AI capabilities for businesses. And that could well be a key area of the market to watch at the close of today's session when the company comes through with its numbers. Another all-session stock on the IG platform gives you the opportunity to trade this when the numbers come out after the closing bell this evening. And that's it for our quick tour around what's happening. Not much change in the markets. The Dow, if anything, is the overperformer on the markets at the moment, looking as though we could well get a nice little cushion of an upside surprise at the start of today's trade. Outside of that, it's tech stocks, which are finding they're going tough, taking the S&P not too far away from where it closed out yesterday's session. That's it from me. I'll be back at 4 o'clock UK time today with a look ahead to Thursday's trade. And again, tomorrow morning, you can catch me again on the early morning call on European markets at 7:30 UK time on Thursday.